Hi everyone, my name is Davi Almeida. I'm a professional hedge fund manager from Brazil. And today I'm gonna interview probably the greatest options researcher in the world, Mr. Kai Zeng. Kai works at the tastytrade research team and he's a specialist in building a portfolio using options. A lot of the things we know about options and a lot of the things we do, like what strategies to use and how and when to manage our positions, are thanks to the amazing work developed by Kai and his research team. Hope you enjoyed the interview.
Yeah, sure. My name is Kai Zeng, and I'm from tastytrade. Currently, I'm working with the research team. So the research team, we produce a lot of quantitative based studies and presentations around the option trading world. So I've been with tastytrade since the very beginning of this company. So right now it's been 8 years. So I've been testing the options pretty much over and over again. I've seen the data since 20 years ago. Every single day I've tested like thousands of time again and again from different angles for different topics, for different underlying through different markets. So if you have any questions, just let me know.
Okay, great, Kai. Thanks. So I want to thank you first for the opportunity to chatting here with us today.
No, thank you for having me.
Yeah, and I want to congratulate you for the amazing job you guys are doing on researching, on backtesting, on portfolio management. It's been really helpful, not only for marketing professionals like me, I'm a hedge fund manager here, but also for the retail investors, for the everyday trader. And is a different way of approaching, of looking at options. In here in Brazil, a lot of options training and options material are pretty much focused on just buying options and trying to hit the lottery and trying to make a big gain in a small time. So
I understand that happens everywhere in the world.
Yeah, I guess I think so. So congratulate you. Thank you for the opportunity. And Kai, I wanna my first question is about buying power, actually, because I guess it's the first question that comes to people's minds, to the traders' minds, when putting up a portfolio using options is how much buying power should I use? How much buying power should I allocate in my strategies? I'm sure that there's not a right number, an exact number, but it's pretty much, of course, if you allocate 100% of your buying power in short strategies, you're probably going to be over allocated. But if you allocate 5%, you're probably going to be under allocated. But is there a right amount? Is there something like, okay, 30%, 40%? Is there something in backtesting and your researching that shows is a better number for you to allocate?
Sure. And we're only talking about the options trading here, right?
Yeah.
So even with the traditional stock trading, allocating 100% of your capital is still should be considered over allocated, because you definitely at certain times you will generate some losses. And for normal margin account, if you allocate 100%, your notional value is actually already exceeds that 100% of your underlying net worth. So it is actually over allocated already. So now we're talking about options, and because where I come from, we only sell premium. So today, if you have a different opinion or questions, we can talk about that. But by default, I'm talking about sell premium option strategies, like sell naked put, naked call, iron condor, strangle, iron fly, J lizard, put spread, call spread. All these are sell premium strategies. Even when I'm talking about the calendar spread, right? When we're talking about long calendar spread or diagonal spread, although we pay debit upfront, but those strategies still collect theta decay on daily basis. So we consider these are kind of selling premium or collecting collecting time value strategies. If we were talking about this, just to answer your question shortly, try never allocate your capital more than somewhere between 50 to 75%. If your capital allocation exceeds 75%, it's a very, very strong signal that you over allocate at a certain point. Can you make profit when you over allocating? Of course, the more capital you use, the more risk and reward ratio you have, which means you actually can make more money or lose more money at the same time. It depends. It purely depends on your position and the market environment. So yes, you allocate more capital, you can make more, but you cannot prevent something bad happening from your position or portfolio. So that is why for the sweet spot, for 80% of the time, you should control your capital allocation under 50% if that's a pure option portfolio, right? I'm not talking about futures. I'm not talking about 75% of your allocated long stock. I'm only talking about the option portfolio. So that's actually a good 50% is actually a good threshold for a lot of people to watch. If you over 50%, you probably want to watch a little bit closely. Getting close to 75% is definitely a red flag. If you're using less than 20% of your capital, you probably want to increase gradually to test where is your sweet spot for your trading style and your risk tolerance level, because everyone treat risk differently.
Yeah. No, perfect. Yeah, people are different. Huh? Some people have more tolerance to risk than others.
Right.
And this is something you actively manage. You're gonna you keep managing. I don't know, maybe a market meltdown, and I'm using too much buying power. It's something you should manage a lot. You should, I don't know, maybe ending some positions, maybe closing some positions to keep the in the perfect range.
Yeah, so that's actually another great follow-up question. So the 50% is kind of a rough number I was talking about, and we assume that you don't even touch your position very frequently. You probably can hold your position. So the normal option management approach is you just hold your position all the way to the end. But we prefer to manage your position a little bit more actively, and you don't have to super crazy manage your position like in and out on a daily basis. We actually don't think that's a great way for majority of the traders. Another way is try to manage your position 3 weeks before expiration, like 21 DTE. And all you need is just manage once before your position getting too close to the expiration date. I'm not going to explain why, but that's kind of one of the rule. So if you follow that rule, 50% is kind of a good guideline for you to manage your portfolio. And the more active you manage your position, if you always stick with the 21 DTE, manage it a little bit early, you actually can allocate a little bit more because you manually reduce your overall portfolio risk by shortening the holding duration. So that is why if you're able to actively manage your portfolio, you should be able to take a little bit more risk, but not more than 75% of your capital allocation. But if we do not prefer to hold your position to expiration, but if you don't have time, you're kind of lazy, you don't want to follow those mechanics, you probably want to scale down a little bit, just because when your duration is your holding duration is long, you actually expose a lot more tail risk toward the end of the expiration cycle. If anything happened to your position or the market, you probably have less capability or capital to manage those positions.
Yeah, perfect. Thanks a lot, Kai. One thing that always comes to my mind is the portfolio data. It seems like a smart way to control your leverage. Keep measuring the data. You think it's a good idea to always looking at the data and always trying to measure your level of leverage through the data?
What type of data you're talking about? You're talking about delta, all these Greeks, or the historical data? Which data you're referring to?
No, the theta, the Greek theta.
Oh, the Greek delta. Okay.
The Greek theta, which is time.
Yeah, I think all Greeks are very important for option traders, especially delta, theta. I think these two are the most important one. The next important one is the vega, and the gamma is good to know, But if you don't fully understand gamma, I don't think that hurts you. But delta and beta are crucial. Why is because delta is probably the most important Greeks in options trading. Delta is kind of measure your directional risk in your portfolio or in certain position. So if you don't know theoretically how many shares you're underlying exposed to, you're in trouble. You need to understand for your current option position, you exposed 50 shares, 100 shares, 2,000 shares in the market, or how many. Then you can mentally convert that to long stock or short stock, how many shares you have. And beta is also equally important because beta is one measurement that's completely different from the other trading vehicles like stocks and futures or Forex, because that actually that associate with the time value. Time value is one of the most special components in the options trading that differentiates option from the other trading vehicles. So you didn't know if my position, if I don't make or lose too much money from the directional bet, I'm neutral or whatever strategy you set up, how much time value can consistently collect from that position or from my portfolio. So I'm actually building a portfolio similar to a landlord. I keep like collecting the rental payments from the tenants. So that's kind of the mindset behind option premium seller. And it's very important to understand delta and beta. So Vega, it is also very special for the option trading because Vega is directly associated with the implied volatility. And implied volatility is a very important and unique feature for option trading. But if you understand, you need to sell the implied volatility when you want to sell the premium when the implied volatility is high, you want to sell less premium when the implied volatility is low, because you always want to buy low and sell high. If you can understand that, Vega become less important because most of the time you probably just watch implied volatility, and Vega is directly associated with the implied volatility. Vega is kind of important. Gamma is if you can understand, that's good, because it's kind of talking about the speed of the delta.
Perfect, Kai. And one thing that's very controversial is define or undefined risk. But many people have a lot of people can take risk easily, but some people just impossible, never go undefined. And here in Brazil, people they have no way you can sell premium undefined. If you sometimes I talk here on the channel about short strangle, you should sell in puts, naked puts, and people say, "Oh, you're crazy! What you're doing?" Because probably because Brazilian markets is very volatile. You see, in 2021, some large caps from the retail industry went 75% down. And
oh, really? Okay.
Yeah, it's very volatile. So you should think about trading here because you have a lot of volatility, Kai. And,
a lot of excitement too.
Yeah, it's a different ride. So you think there's a right mix between defined and undefined? Of course, if you have a small account, you just can't go undefined. But if you have a large account over 1 million, 2 million, I don't know, something like that, you should go a lot of undefined risk. You should mix defined and undefined. What can you say to us about that?
So risk defined strategy, that's another great question. And everyone encountered that question when they're becoming much better option traders on the way. So everyone started with a risk defined strategy, pretty much everyone, or everyone started with a long call, long put trader, right? Then we started to realize, oh, there are premium sellers. Then we probably want to choose risk defined strategy. Then one day, a lot of people talk about naked position, sell premium, but as a new trader, probably less than 2 years, there are some challenge to choose those naked positions, because theoretically they have unlimited risk, especially to the upside, right? If you short a call in Tesla or some great stocks, you actually definitely can get hurt and over again. And like what you said in Brazil, if some stocks that drop 75%, if it's short naked put, definitely you can get hurt too. I don't know too much about the option market in the Brazil, but overall, the option price should be accurately priced according to different market. If the Brazil market or some other emerging market is very volatile, the option price should be the premium should be adjusted accordingly, right? If the volatility is really high, that premium is probably going to be 3, 4, 5 times higher than the U.S. equity, because the higher the volatility, the higher the potential implied volatility, the higher the option premium. So these should be adjusted, but I don't know how much risk really associated with the Brazil market. But overall, yes, we have some risk associated with the naked position. If you want to stay with the risk-defined strategy, that is fine, because there are different ways to adjust the risk-defined strategy. A lot of us, if we trade $100, let's say $50 worth stock, we probably start with a $1 wide spread, put spread or call spread. Then we realize, oh, $1 wide, we couldn't make too much money, probably $30, $40, $20 in one trade. Then we can actually widen it out, right? So we can widen it to $2 wide spread, $3, $4, $5 wide. So for $5 wide, your max loss is not going to be higher than $500, but you probably can make $100 and $200. Depends on how much premium you collect. And if you have a larger account, you still don't want to trade naked position, that's fine. You can make it $10 wide or $20 wide. So whatever the width of the strikes you choose, the between short and long strikes, that's the maximum loss it can generate in your position, right? Theoretically, if you have a $10 wide spread, the maximum amount you can lose is $1,000. So you can adjust that based on your portfolio size. So theoretically, the larger the portfolio, the larger the position you should put on for individual position. So there are two different ways to use your capital. One is trade very small position, but we use multiple contracts, right? So let's say we want to use $1,000 capital, we can either trade $1 wide spread, or we trade 10 contracts. The second way is we just use one contract, but only one position, but that position is actually $10 wide. So these two positions, if you can make the numbers right, theoretically, their max risk can be same. But actually, in your trading, your probability, your theoretical risk actually are different. When you have more capital, you need to trade larger single position, but less number of contracts. There are multiple reasons to do that. One of the most obvious reason is when you have more capital, you don't want to put a 1,000, 10,000 number of contracts. It actually chew up a lot of your commissions. You want to trade bigger position, but fewer number of contracts. And eventually, if you have a 7-digit, like more than like $500,000, $1 million, or even higher, naturally you will start to pick up the naked position, no matter you want it or not, because that's one way to more efficiently use your capital. Other than long stock can take up a lot of the capital. If you use options, you cannot just trade $1, $2, $5 wide spread or iron condor. It only takes up your $400, $300, $200 capital. How many contracts do you have to trade to use up your capital, right? When you have more capital usage is actually become another very important topic. But most of the retail traders, if we only have $10,000 or $25,000, we don't have to worry too much about that. But if you want to step up and try naked position, try less volatile stocks. Let's say try SPY, QQQ, or Apple. These underlyings don't have liquidity problem. Pretty much everyone trade them. So you can try some small naked position, but I know QQQ and SPY and Apple is already very expensive. So try some stocks, let's say lower than $50. So your overall
maybe a cheaper ETF.
Yeah, ETF is great too. Yeah, great start. There are a lot of sector ETFs. So if it's under $50, the underlying price, your naked put overall buying power requirement is probably going to be somewhere between $500 to $1,000. So you still can control your risk. And if something happened, these underlyings is actually not going to go crazy as kind of a GME or AMC.
Yeah, perfect, Kai. It's a big doubt I had, and now it's much more clear here. Kai, I understand that You're not only a great researcher, but you're also a great trader. So you have any tips, any step-by-step guide for you? How do you choose what to trade? How do you start a trade? You look just by volatility. You look at the company's numbers, any fundamental analysis, something like that.
Yeah. So I created. So you invited me to this interview because of the portfolio series I put together with Dr. Jim. I actually created a multiple series all about the trade management and portfolio. And I started in 2018 and all the way to right now. And the very first series I created is, so there are 3 different levels. I kind of categorize different option traders. The first one is we try to get familiar with everything, get familiar with all the different new terms, different strategies, why this one associated with a higher risk, why that one actually can get higher return, or why this one has higher probability of profit. So the first stage is actually you try to not make mistakes. You learn everything. You absorb all the new knowledge from the option trading. You know everything. But even if you understand everything, you read all the textbook, doesn't mean you're a good trader. But this is the step 1. This is phase 1. You need to understand majority of the important things, just like the Greeks, right? You don't have to fully understand the gamma, but you definitely need to understand delta and theta, and kind of understand the vega too. So if you understand these, and you can put on some trades, right? I can put on if I want, I can put on a call spread. I can sell naked put. I can sell the iron condor. I can put it on a calendar. If you're able to put it on, take it off correctly without making messed up, without making mistakes, and you take it off one leg and forget the other one. I think that's the phase 1. So you can execute, you understand everything, and you can execute it correctly. Although you probably couldn't make any money, or you don't know what you're doing over the long term, but that's phase 1. The second one, I call it, you can accurately manage your position. So I know what I'm doing. I know why I put on this position. I know when I need to take off that position at where, right? Should I take my position at 50% of the max profit I'm able to collect? Or should I take it off at 3 weeks before expiration date? Why should I do that? And what kind of risk and reward I'm looking at by doing this, by following this approach? If you can correctly manage all your trades, we're not talking about making mistakes. You're actually start to making small profit, or you don't lose money over the long term. I think one of the best advice from a very successful professional trader is try trade as actively as possible in 2 years and never lose a dime. That's actually great advice, right? Trade as many as possible in 2 years, and if you're able to if you're able to not lose any money at the end of 2 years, I think that's a very successful. It can be a successful story. So I think this is kind of phase 2. You know what you're doing. You try to manage your position, and you don't lose money, or maybe you make a small profit. And the most important thing is your profit is not you make $50,000 one time and lose $20,000 another like 5 times combined. You need to understand what you're doing and why you're able to making those small profit, or you're not losing money. These kind of a phase 2. The phase 3 is actually what I try to do in 2020 or 2020 for portfolio management. So eventually, our goal for as trader, our goal is not like try to make $50 to buy Starbucks, couple of Starbucks for the whole week. Then the rest of my life is good. We're trying to make some profit, right? We're trying to make some wealth. So eventually you will grow your trading account from $5,000 to $20,000 to $50,000 to $100,000 even more, because why we become junk trader or addicted to option trading, because we want this one way or one very effective vehicle to create some of the wealth. So if you want to do that, eventually you will step up to the phase 3, which is you want to become a smart portfolio management, a smart portfolio manager. Because in phase 2, you can trade Tesla, you can trade Apple. I can speculate the GME. I can speculate some Brazil very volatile stock and make some money and lose some money. But eventually, after you get married, you make more money from your salary. you start to think about how am I build up kind of a wealthy portfolio that can sustain my lifestyle or whatever, right? So that's where the portfolio management comes in. It's become extremely important. Now you're talking about a big plan and in a different strategic level. You want to know how much money I have, or down the road I'm going to commit it to the trading, to trade options, how much I'm committed to just long stock or real estate or whatever. For option trading, then you need to know how much capital I want to constantly allocate it into this trading environment. When the implied velocity is high, when the implied velocity is low, when the market is extremely good, like the US in the past 7 years, how much capital I want to allocate, what kind of position I want to put in. If the interest rate is going to increase, something uncertain is going to happen down the road to the world, to US or to the Brazil, then how should I adjust my portfolio? I'm not talking about I should manage your position of 21 days before expiration or 15. These are kind of micro. But when you're talking portfolio management, you need to know what kind of sector I need to commit more capital, and how many position I need to allocate. Should I increase my number of underlying from 15 to 30, then increase the number of position from 1 for each underlying to 2 or 3 for each underlying. So total we probably have 90 positions, 30 underlying, 90 positions, or we want to downsize to 20 underlying, but each underlying I have 5 positions. So these are kind of in a bigger scale, how you want to manage your position. And also how much capital I need to allocate to naked position, and how much position I want to allocate to the cover call or the risk-defined strategy, like the call spread, put spread, iron condor. So these are kind of in a different level. If you're able to focus more on this side, right? I constantly monitor my portfolio about the delta ratio, how many data I collect on each day. These are kind of in a bigger picture. Everyone need or will need to master when they trade a little bit bigger portfolio.
Perfect, Kai. Agree 100%. And this is golden, because when you start growing your account more and more, and you start managing other people's money, you have maybe a hedge fund.
You have a hedge fund, you understand that for sure.
Yeah. You look at the risk of the whole thing, all your positions. You have to look at the market reality now. You have to do projections, and options is just a part of the world of the investment world.
Right, and also as a portfolio manager, you need to constantly monitor your risk and reward ratio. You're not only thinking about, okay, this year I'm going to do 30% return of capital. That's not the only criteria you're chasing after. Yes, profit is everyone want, but it's not the only thing you should look at or monitor. There are a lot of things, so you need to constantly monitor the risk level when you have more and more money or fund in your trading account.
Yeah. When it's a fund, things get a little bit tricky, because you have maybe 2 or 3 months down months. People start to withdraw their money. Yeah. And so when a fund is a little bit different, the risk control.
Yeah.
What about low volatility environment, Kai? You trade low volatility strategies, debit strategies. You do this kind of thing?
Yeah, so low implied volatility. So as premium sellers, low volatility environment is a little bit tough. Like somewhere between 2013 and 2000 and before the end of 2018, we've been monitoring the market forever, and that market was tough because the VIX was constantly trading below 13, 12, 11, 10. I believe in 2016 or 17, maybe 16, the lowest VIX number ever was 9.93 or 9 point something. It's definitely below 10. So these markets are pretty tough for a premium seller, and a lot of premium sellers actually start to changing their camps, right? They're changing from short implied volatility to long implied volatility camps, start to long some naked put or whatever. So these could be a tough time for the premium sellers. So, but still, I'm a full believer for selling premium in option strategy over the long term, because that still is a game changer so far. So talk about what kind of strategy we can use. That's still a micro level. The strategy you can use for low implied volatility definitely is the calendar, diagonal, these strategies, because these are kind of a long implied volatility strategies by using the time spread. If the implied volatility potentially can increase down the road, you're able to make some money or offset some of the losses you create in your position. And another good advice is from the kind of a strategic level. If the implied volatility is low, just use less capital to trade. I always thinking like trading market is like a how to say, it's like a surfing, right? So the wave can be high and low. You don't have to stand on the top of the wave at the tip of the wave all the time. If time is good, market's good, use 50%, 55, 60, 65, or getting closer to 75% of capital if you're good to control your position and capital. But when time is not that good for you, when volatility is constantly low, just like a scale back, use 25%, somewhere between 25, 50%, keep your safe. The time will come. I know in the past 7 years, the market was so low for so long and the market was so bullish. It has this time. So just try to take a look at the risk side more often than your potential profit. You probably will lose less for a majority of the retail traders.
Yeah, no, perfect. Time will come. You have to be patient in this kind of situations.
Yeah, so 2020 is a perfect example, right? A lot of new traders actually make more money. So these are kind of great examples. Between 2013 and 2019, so many tasty traders complain about the boring market, low premium, kind of a relatively bad return to capital, because for low implied volatility environment, for a naked position, you need to put up more buying power requirement, and the premium is lower. So your potential return divided by your cost is actually even lower number. So that's where a lot of complaints coming from. But see, in 2020, something happened, right? March 2020. So a lot of traders, even new traders, make a lot more money because the implied volatility is so high. It's even higher than after 2008. This is a great time. A lot of people can sell premium, but that's also another time, a time that scared a lot of people away, right? Because the market was so volatile in between the March and June 2020. But a lot of people are able to make a lot of money by setting strangle or naked put. Naked put is the biggest winner. And also right now, the implied volatility level is still up 20% today. So between March 2020 to right now, almost 2 years, the average implied volatility was extremely high, even higher than after 2008. So these are all very positive signs for premium sellers. So yeah, good times and bad times, who knows, right? Before March 2020, so many traders, they complain, oh, this is a very bad strategy. But after that, a lot of new traders, oh, trading options is so easy, I can make 40% in the 2020 or 2021. Both can be confusing and probably not correct over the long term. Some people just step into the wrong time, and another one just lucky, just step in a very, very good time selling premium. So you need to look at the over the long term. Market will come down to the average level. You will see up and down. You will see the normal volatility come into your portfolio. You will not only lose money, you will not only make money. You're going to see normal volatility up and down, P&L changing. These are kind of the right expectation you should set up for your portfolio.
Yeah, perfect. And how you're looking at the market in 2022 now, Kai? You think what we have seen in the end of 2021 was S&P going high all the way and breaking records, and the implied volatility was not that low. It was like, it was a little bit different because we're seeing the record high on the S&P, and implying volatility was also a little higher, maybe 25, a little over 20. Yeah. And you think that this is a trend, something that's going to go up? Because now probably the interest rates are going to go up. So people are not going to start hedging themselves with options. Going to start hedging themselves maybe on the on the market of buying the PU, buying the flight to safety when marketing goes down. So what do you think about 2022? How you seeing this?
So personally, I don't make market prediction. And also, I don't think I'm a very good market predictor. It all depends on, as a trader, all comes down to how you're going to react to whatever the assumption you have or whatever the thought you have, right? Everyone has different assumption about the market or anything. And if you have that thought, the most important thing is how are you going to react to it, right? Right now, we have a market. We don't know what's going to happen. We have a tool, which is options. We have so many different strategies we can select. We can deal with different type of scenarios. And so the question comes down to everyone. If you're bullish, what are you going to do with your portfolio? If you're neutral, what are you going to do? If you're bearish, how are you going to change your setups? So these are kind of important things for any traders right now. So for me, I'm not that. Give me 1 second. So for me, I'm not that bullish over the years. It's been years I'm not that bullish, but markets just keep going higher and higher, breaking records every single day or every single week. Who knows? But we still need to have a strategy or part of portfolio to deal with that. I'm kind of a neutral to slightly bearish, so I'm constantly put on neutral position. And if my assumption becomes more bearish, I start to adjusting my position from more naked position to a little bit wide risk defined strategy, right? So let's say I used to put on a lot of naked position. When I see the implied volatility might go up and the market might pull back, I probably scale back first. I use less capital to trade, right? I take off some of the unnecessary positions. I don't have to hold for a long time. And second one, I probably convert naked position to wide strangle or put spread. Let's say I make it, if I sell naked, put in SPY, I probably convert to $20 wide. If I kind of sense there are more risks down the road, I make it $10 wide. So I start to reduce my single risk in my portfolio gradually. So these are kind of the way I try to deal with the market. Although I still could be wrong for months or even years, who knows? It depends on a lot of factors. But I think the most important thing is, as a portfolio, that's the only thing everyone cares about, and it's most important to you, how you're going to adjust that. And also, I personally a little bit bearish, which means I sense the volatility or risk is coming up down the road. If I feel that, I need to reduce the risk in my portfolio. That's the most important thing, and I'm doing that. So gradually, again, I think that's what I try to say. I don't predict it's going to go up another 20%, down 20%. That doesn't matter.
Perfect, Kai. Well, that's pretty much it. That's the questions I had. It was amazing. You give a class here. I'm sure you're gonna be popular here in Brazil after this video.
Sure. I know we have a lot of Brazil viewers on tastytrade platform. I constantly got a lot of emails from people from Brazil.
Yeah. A lot of people in Brazil, the derivatives market here in Brazil is big actually, but it's big on commodities like corn and soybeans. It's huge. Brazil has a huge stock exchange on commodities. On options, from stock options is a tiny market. The whole Brazilian stock market is smaller than Apple. So Apple alone is bigger than the whole Brazilian market. Yeah. So it's a small market, but a lot of people trade here in Brazil. Is popular, and a lot of the mechanics, some things like road the untested side here are becoming very popular. People are.
Oh, really? Okay.
Yeah.
That's one of the active management approach that everyone should try. Is pretty good.
Yes, it's pretty good, and people are really interested in this kind of thing. So thanks a lot, Kai. Thanks a lot, and congratulations for the amazing work you're doing there on tastytrade. Maybe we're gonna do another chat some other time.
Yeah, that's fine, anytime. And thank you for having me.
Thank you. Have a great 2022. Bye-bye, Kai.
You too. Safe trading.
Thank you.